All right, first and foremost, this is for educational purpose only. This is not investment advice. I don't know your specific situation and what you're dealing with, but this is just a good guidelines to understand how we come at looking at pulling money out of the market to fill your paycheck bucket. Really think about that, the money that you need to live off of in the short term while letting the long term grow and move as it needs to. Start with the retirement waterfall concept, and this is how we think of it. The paycheck bucket is typically 1 year of income. If you have $1 million, let's say that's 5%, that's going to be $50,000 that we keep in this bucket, right? And we can take that out monthly, and you should be able to live off of that no problem, as if it were a paycheck, so nothing really changes in your life. If you're used to getting a monthly paycheck, this is how you can maintain that in a retirement or at a time you just want to live off of your investments. So then we have two other buckets, and we have the next one we call maintain, and that can be more short-term bonds, short-term risk, a little more risky than just cash or money markets that we would keep in the paycheck bucket, but a little more long-term, and that might be the next 4 years. So basically, between these two, you have 5 years of income, and then everything beyond that, you push in the growth, right? You let that grow to fill up these other two buckets in good times. So what defines a good time, and what helps us understand when is a good time to pull money out of that growth bucket to fill the maintain and paycheck buckets? And that's what I wanted to get into today. First of all, the money flow index is what we're going to look at here. And it's a technical oscillator that uses price and volume data to measure money flowing in and out of a security. And for this example, we're going to use the S&P as the example, and what we're looking at as to when to pull money out of the market. It's fairly similar to the RSI, which is the relative strength index, but it does also have volume associated. Now, we tend to use the RSI a lot, but we use it on a shorter term time frames. I find this space a little more useful in the bigger, trying to find 1 or 2 times a year where it's really good peaks to pull money out of the market. Right, so here's the S&P. There's the last 3 years of data, and then we have the MFI, the money flow index at standard settings. So every time the reading gets above 80, we look at here and say, okay, this might be a good time to pull money out of the market and fill the other buckets. So we had one there. We had several in 2021. In 2022, when the market is falling, that's really suboptimal to be taking distributions out, because that can really wreck your retirement long term. If you're taking money out lower and lower and lower every time, when the market does turn around, you don't have enough money in there to recoup fast enough to really be able to maintain your lifestyle. So that's really the whole point of this. So when 2022 in the bear market, it helped us find a good peak to pull money out and refill the other bucket. So we're not pulling out down here at the bottom, not selling at the bottom, but rather closer to what a top could look like. And back here in 2023, that's this year, around July, we had a good spike, and then we had a pullback. And then just a few weeks ago in November, we had the same kind of thing. It looked like it was very peaky, but it is continuing up from there. So it's not always right. It doesn't always nail a high, but I find in many cases, especially bad markets, it helps you pull money out when it's an opportune time versus just pulling out arbitrarily, and it could be retirement wrecking. But that's what I want to come at today. So we want to pull from the growth when it's optimal, and then fill your paycheck buckets to make sure you can maintain an income through your retirement or whatever frame you want to be living off of this money.